Have you ever stared at a stock chart and just wondered, is the secret to what happens next buried somewhere in all those squiggly lines? For traders, that's the million-dollar question, right? And one of the main ways they try to answer it is with something called a technical indicator. So let's pull back the curtain and see what these tools are all about. You know, every single one of these little bars and candles, it's a story. It's a battle between the people buying and the people selling. You're looking at a rich history of price, volume, and momentum. And technical analysts, well, they believe that inside these patterns, there are clues, little echoes of human psychology that just tend to repeat themselves over and over. And that, right there, that is the heart of what we're talking about today. Can these fancy mathematical tools really give us an edge? Can they help us predict where the price is going next? Or are they just a complicated way of looking in the rearview mirror?
Here's the thing. The biggest challenge isn't a lack of tools. There are thousands of them. The real problem, the common enemy for every single trader, is the false signal. You know when an indicator screams buy right before the stock completely tanks? Learning how to filter out that noise, that is the key to unlocking what technical analysis can really do.
So to figure out how to dodge those false signals, we've got to get really clear on what these indicators actually are, what they do, and maybe just as important, what they don't do.
At its core, an indicator is really just a math formula that takes all that raw price and volume data and transforms it. But here's the crucial part, and you got to remember this. It's a derivative of the price. That means it's one step removed from the actual action. It's not the price itself. It's a reflection of it.
And these formulas, they basically serve three main purposes. They can act as a warning sign that maybe momentum is fading. They can help you spot a trend that's picking up steam. And yes, they can be used to generate specific buy or sell signals to try and predict where the price is headed. But like we just saw, that last one, that's the trickiest of all.
Okay, so let's get our hands dirty and look at two of the most popular indicators out there. Now, they both measure momentum, but they do it in completely different ways. We're going to be talking about a specific category of indicators called oscillators. Just think of them as gauges designed to show you when a move might be running out of juice. When an oscillator gets way up to the high end of its range, we call that overbought. It's a sign the buyers might be exhausted. And when it hits the very bottom, it's oversold, which suggests the sellers are getting tired. Okay, this is a brilliant way to understand the difference. Think about it like this. The RSI, or Relative Strength Index, is all about the magnitude of price moves. It's asking how strong are the winners versus the losers. The stochastic oscillator, on the other hand, measures speed or velocity. It's asking where is the price closing compared to its recent high-low range. See, a stock that keeps closing near its highs has some serious internal momentum, even if the price itself isn't making huge moves.
So, what do we have? We've got one indicator for magnitude and one for speed. The big question is, how do we combine these two to our advantage and finally start filtering out those nasty false signals? Well, that's where the strategy comes in.
It's a totally fair question, right? If you're trying to build a case for making a trade, does adding more evidence make that case stronger? Well, in this situation, the answer is a big fat yes, but only if you combine them the right way.
The secret sauce here is a concept called confluence. It's a simple but powerful idea. A signal is just way more reliable when two different complementary tools are telling you the exact same story at the exact same time. You're not just looking for a single clue, you're waiting for all the evidence to line up. And this brings us to what we're calling the double punch method. It's a fantastic way to use the unique strengths of both indicators. We use the slower, smoother RSI to tell us when the market is stretched way out to an extreme. That's our setup. Then we use the faster, more sensitive, stochastic to give us the precise trigger for when it's time to act. It's a 1-2 punch. All right, enough theory. Theory is great, but let's make this real. Here is a super simple 3-step framework for putting this double punch strategy into practice.
It's this simple. First, we figure out which way the main current is flowing, the overall trend. Second, we wait patiently for our slower indicator, the RSI, to give us the setup. And third, we use our faster indicator, the stochastic, to pull the trigger.
Okay, step one is absolutely critical. Rule number one is you never fight the dominant trend. It's like trying to swim up a waterfall. A really easy way to see the trend is with a 200-period moving average. If the price is above that line, we're in an uptrend, so we only look for chances to buy. If the price is below it, we're in a downtrend, and we only look for chances to sell. This one filter alone will save you from so many bad trades I can't even tell you.
All right, let's walk through a buy setup. So, The price is clearly above the 200 moving average, which means we're in an uptrend. We're in buy mode. Now we just wait for the price to pull back a bit. And right here, you can see the RSI dips below that 30 level, signaling that oversold condition. The stage is officially set. This is our setup.
So now that we have our setup, we zoom in and look for the trigger. While the RSI is still hanging out in that oversold area, we're watching the stochastic like a hawk. And there it is. See that? The faster blue line crosses above the slower red line. That crossover is our high probability signal to jump in, timed perfectly at what could be the very end of that pullback. So let's just recap the perfect buy signal. First, we've got the trend on our side. Second, the RSI gives us the setup. It tells us the market is oversold. And finally, the stochastic gives us that trigger, the exact moment of confirmation. Every single box is checked. This is what a high probability trade signal looks like. Now, this manual 2-indicator strategy is pretty powerful stuff, but honestly, it's just the tip of the iceberg. This same idea, this principle of confluence, is now being scaled up on a massive level by artificial intelligence, and it could totally shape the future of how markets are analyzed.
Just think about it for a second. What we just did with 2 indicators, a machine learning model can do with 20 or 50 or 100 of them all at the same time. These models are essentially running a gigantic automated confluence check looking for tiny patterns across dozens of variables that no human brain could ever hope to track.
And what's really fascinating is that different AI models seem to be better at different things. Research is showing that models like what's called a random forest are amazing at very short-term predictions. We're talking 1 to 5 minutes out. But for looking further down the road, another model like Light GBM often gives a much more stable and reliable performance.
And what charts like these really drive home is a universal truth. Just like there's no single magic indicator that works all the time for a human trader, there's no single magic AI model either. The best tool always depends on the situation and your time frame. The core ideas of filtering out noise and finding the right tool for the job, they're universal.
So, this brings us all the way back to our original question. Are technical indicators a crystal ball that can tell you the future with 100% certainty? Absolutely not. No way. Instead, a better way to think of them is like a better pair of glasses. They help us filter out all the market noise, see the underlying momentum more clearly, and at the end of the day, make decisions based on probability, not prophecy. So maybe the real question isn't whether they can predict the future, but whether they can help us make a much smarter decision in the present.